In terms of what's going on in the markets, let's first talk about a topic that almost no one realizes is happening right now and will continue throughout the rest of the year, and that's what's known as the Japanese carry trade. Look, even though this sounds like a complicated term, it's really easy to understand once we break it down. See, for more than 30 years, the Japanese yen has declined. In fact, their financial system was so bad, with decades of deflation, an aging population, and weak demand, that their interest rates have remained near historic lows just to incentivize borrowing, spending, and trade. And they could get away with that up until recently because their inflation rate was pretty much non-existent. Now, in most cases, this isn't that big of a deal, and globally, interest rates do tend to balance each other out. But a few years ago, something changed. Because the United States battled with record high inflation from 2021 to 3, the Federal Reserve was forced to raise interest rates at their fastest pace ever in history. And all of a sudden, the United States was paying much more in interest than practically every other country, risk-free because we could always just print more money. This presented a very unique opportunity where traders were able to borrow the yen at a cheap interest rate, buy the US Treasuries at a much higher interest rate, and profit the difference. Basically, this was the equivalent of borrowing at 0.5% in Japan, buying a treasury in the US that pays 5.5%, and then making 5% for doing practically nothing.